Very good morning, everyone. In this presentation, I'm going to cover what is capital gains as per New Income Tax Act 2025. I will also explain what are the core changes between Old Income Tax Act 1961 and New Income Tax Act 2025. Before that, I'm going to introduce there are total 5 heads in the Income Tax Act. That heads are not changed in the Income Tax Act 2020-25 also. Namely, income from salary and income from house property, profits or gain from business or profession, and capital gains, that is I'm going to cover now, and income from other sources. Income from other sources is the residuary income head in the Income Tax Act 2020-25 as well as Income Tax Act 1961 also. So without facing further time, we will see the what is capital gains as per Income Tax Act 2025. So first, what is capital gain? For this, capital gain means profit or gain arising from the transfer of capital asset. There are two conditions need to be satisfied. First is capital asset must be exist and transfer must take place. So if these two conditions are satisfied, then that income, which means total cost minus total sale consideration minus cost of acquisition, will be taxed under income from capital gains. It will covered in the section 67 of Income Tax Act 2025 and section 45 of Income Tax Act 1961. There is no major changes between these heads, these sections in the Income Tax Act 2020-25. Generally, capital gains is taxable in the year in which asset is transferred, not in the year of receipt. We will see what is capital asset, what is transfer, and some cases in the year of receipt, it will be taxable. We will see what are the exceptions for that. So capital asset. Capital asset is covered under section 222 of Income Tax Act 2025. Earlier Act 214 covers capital asset. Earlier Act means Income Tax Act 1961. Capital asset means any property or kind held by the assessee, whether it is fixed or circulating or movable or immovable, tangible, intangible, anything, it will be covered in the capital asset category. So there are two, I have taken two types of list for capital asset. One is positive list, that is these items are held treated as capital asset, and some items are specifically excluded from the capital asset. First, movable and immovable property. All movable and immovable properties are capital asset, and shares, debentures, bonds, unit-linked insurance premiums, all are capital asset. And specifically, virtual digital asset, that is cryptocurrencies and non-fungible tokens, are treated as capital asset. And this it is coming, though this is coming under the capital asset category, it is taxed under the different rate, that is 30%, flat 30% taxed, and no carry forward of loss will be allowed for virtual digital asset. And next one is goodwill, patent, trademark. These all are the examples for the intangible assets, which is also a capital asset. And jewelry, paintings, sculptures. Jewelry is a personal effect, but though it is a personal effect, it will covered in the capital asset. Some personal effects are covered in the capital asset. We will see in the exclusion list. And urban agriculture land. Rural agriculture land is not a capital asset, but if it is covered in the urban agriculture land criteria, then it is a capital asset. What is urban agriculture land? We will see the definition in the subsequent slides. Right in an Indian company, whether right to manage the company or right of control to the company, it is the capital asset. If we are transferring right, then it will be covered in the capital gains provisions. And what are the items excluded from the capital assets? First, stock in trade, consumables, raw materials, because these stock in trade, consumables, raw materials are business assets. So it will be covered in the PGBP, that is profits are gained from business or profession category head. So it will not cover in the capital gains head. Personal effects such as clothes, furniture, car, etc. and all covered as treated as personal effects, this will not be treated as capital asset. But jewelry, archaeological collections, sculptures, paintings, drawings, these all are capital assets. And if you are selling those jewelry or capital paintings, then capital gains will be attracted. And as I said earlier, agricultural land rural area in India is not treated as capital asset. And gold deposit bonds, these are the old gold deposit schemes that will also excluded from the capital assets. We will see what is transfer. Section 2109 of Income Tax Act 2025 covers transfers definition. Earlier Income Tax Act Section 247 covers the transfer definition. There is no major change between these two acts. What is transfer? If we are transferring any, transfer means sale or exchange or relinquishment of anything, and extinguishment of right in an asset, and compulsory. Say for example, if any land has been acquired by compulsory acquisition, say for example, if any land is acquired by the government by under the Compulsory Acquisition Act, then it is also treated as transfer. And subsequent is conversion of capital asset into stock in trade. Say for example, if you have the jewelry of 500 grams and you are going to do jewelry business, if you are converting your jewelry into business asset, which means that 500 grams jewelry you are going to use as business assets and sell it as to the customers, then such transfer, then such case also covers under the head capital gain. Then maturity or redemption of zero coupon bonds. Redemption of zero coupon bonds also cover under the head capital gains. And final one is allowing possession under Section 53A of Transfer of Property Act. That will also, that is, you are transferring movable property or any property, then that will also treated as transfer. The transfer definition is an exhaustive definition, which means whether these items are included as transfer, no. This is just examples for the inclusion of the transfer. The transfer definition is so much exhaustive, so it is wider. We will see what are not treated as transfer. See, generally everything covered under transfer, but some exceptions has been given in the Income Tax Act itself. What are those exceptions? First one is transfer total partition of HUF, which means if you are member of the HUF and you receiving the partitioned asset from the HUF, then it will not be regarded as transfer for the purpose of capital gains. Second one is gift or will or irrevocable trust from the individuals is not treated as transfer. Third one is transfer between 100% holding company to 100% subsidiary company, then this will not be treated as transfer. Amalgamation cases also will not be treated as transfer. Demerger shares transfer, demerging company transferring shares to resulting company, then that will also not be covered as transfer. Conversion of bonds or debentures into equity shares of a company, that is also not treated as transfer. Conversion of firm or sole proprietorship into company is not treated as transfer, but company into proprietorship firm or sole proprietorship will treated as transfer. Then capital gains will be attracted for that conversion. For converting firm or proprietorship into company, capital gains will not be attracted because it will excluded from the transfer definition. So we will see what are the key rules. First, for listed shares, if you are holding more than 12 months, then it will be treated as long-term capital gain. If transfers have been arisen holding more than 12 months, then it will be treated as long-term capital gains. And sham bogus transactions are not covered. Say for example, if you are holding as investment for more than 12 months, then it will be treated as capital gain. Or if you are doing a business and holding a shares for more than 12 months, share trading business holding a shares for more than 12 months, then it will be treated as capital gain. Yes, it can be treated as capital gain provided it is not a sham or bogus transactions. Otherwise, AO will interfere the transaction and he will decide whether it is PGBP or capital gain. And unlisted sets. For removal of ambiguity in the taxation, CBDT has issued specific circular and it has been unlisted shares always covered under capital gains head only, no PGBP heads. And as I said earlier, urban agricultural land only covered under capital asset and subject to tax in the capital gains head. Rural area, rural agri land will not be covered as a capital asset. Also, transfer of rural agricultural land is exempt from the tax. So, what is urban agricultural land? So, we need to check the definition for the same. We need to check the distance from the local limits, which means from the local limits means municipality limit or cantonment board limit in case of hilly areas. So, municipality limits means if the end of the we need to check from the end of the municipal limit. Say, for example, for Coimbatore, Neelambur is the municipal limit. We can take it as Neelambur as a municipal limit. From Neelambur, we need to take this distance. If it is less than or equal to 2 kilometers and the population is the more than 10,000, then it is a urban agricultural land. And if more than 2 kilometers from the end of the municipal limit, but it is less than 6 kilometers from the municipal limit and population is more than 1 lakh, then it is a urban agricultural land. It is more than 6 kilometers, but up to 8 kilometers and the population is more than 10 lakh, then it is an urban agricultural land. So population means population need to be taken as on the date of 31st March and the 31st March if any census is published before that. So agricultural land is a broader concept, and if it is more than 8 kilometers, then if it is definitely an rural agricultural land, then capital gains tax will not be attracted. If it is an urban agricultural land, we have exemptions, some kind of exemptions. We can take it as we will take it as in the next webinars. So year of taxability, as I said earlier, so year of taxability is general rule is year in which asset is transferred and that year only taxable. Such gain will be taxable in that year only. TDS may be receipt may be in the subsequent year, but taxability arises as and when asset is transferred. For taking 3DS credit, we need to fill it in the ITR form that we are not offering this. We are earlier year we have offered so and so income. Then in this year we are taking credit only. So some ambiguity is there, but we can take it as. So I have given the situation and year of taxability. So first, normal share exchange in the year in which transfer took place, that year we need to pay the tax. For compulsory acquisition, we need to pay the tax in the year of compensation because we don't have funds at the time. So conversion of stock in trade. If stock in trade is converted as capital asset, then such if capital asset is converted as stock in trade, then such tax need to be paid in the year such stock is sold. Insurance claim for destruction or demolition, for that we need to offer it as tax in the year in which receipt has been received due to uncertainty of receipts. And joint development agreement, we need to pay the tax in the year in which completion certificate is received. And distribution by the firm to the partner, capital asset is distributed by the firm to the partner, then we need to pay tax in the year of transfer. So next meaning is short-term versus long-term. What is short-term assets? What are long-term assets? So Say for example, in case of listed equity or listed equity mutual fund, STT, Securities Transaction Tax is paid, then it is treated as short-term capital asset if it is held less than 12 months, which means if we are holding asset less than 12 months and within 12 months we have sold the asset, then it will be treated as short-term capital asset for listed equity shares and equity-oriented mutual funds. Equity-oriented mutual fund means holding more than 65% of mutual funds in equity manner only. And unlisted shares. Unlisted shares, if it is held more than 24 months, then it will be treated as long-term capital asset. Otherwise, it will be treated as short-term capital asset. Why long-term and short-term capital assets are important? Because of the tax rates. Tax rates are different for long-term capital gain and short-term capital gain. So we need to understand this also. Zero coupon bonds for holding more than 12 months will be treated as long-term capital gain. Long-term capital asset. In debt mutual fund, it is short-term capital asset if it is holding more than 12 months, less than 12 months. Virtual digital asset, cryptocurrency. For this, long-term or short-term is not at all relevant because it will be treated as flat 30%. It will be treated as transfer and taxed at the rate of flat 30% with surcharge and health and education cess. Gold, jewelry, other assets, these all are treated as long-term capital asset provided if holding period is more than 24 months. And period of holding, these are the key deemed dates, which means from which date we need to take the asset as holding date. Say for example, for bonus shares, from the date of allotment till the date of transfer, we can take it as period of holding. For right shares, date of allotment, we can take it as like bonus shares only, we can take it as right shares also. For inherited property, there is a huge impact on this because for inherited property, we can take the date of acquisition by the deceased person, which means the deceased person, when he originally buys the asset, from that date till the date of transfer, we can take the period of holding. Because property alone have indexation benefit. For other assets, there is no indexation benefit as per the Income Tax Act 2025 and Income Tax Act 1961 also for the financial year 25-26. Gift received. The gift received means then period of holding, date of acquisition shall be date of acquisition by the original donor. Employee stock option plan shares. Then in that case, date of acquisition will be date of exercise of such option. Only at the time of exercising the option, we are going to get the shares from the company. So from the date of exercising of option only, we need to take it as. And for listed shares, contract note date, not demat credit date. This is an important point. And amalgamation. For new shares, date of acquisition shall be the original shares, because amalgamation means one company shall be amalgamated into another company, then existing company shares are not going to be valid and new shares shall be issued by the amalgamated company. So then in such case, we can take the period of holding from the date of original company date, original company acquisition date. For mutual fund switching between plans, there is original acquisition date need to be considered. And computation of capital gains. Section 72 of Income Tax Act 2020-25 covers computation of capital gains. Whether it is a short term or long term, this section covers. Section 48 of Income Tax Act also same. There is no distinction between these two sections and these two acts. First, we need to take the full value of consideration, and we can reduce the transfer expenses such as bonus, brokerage, registration charges, stamp duty paid, and legal charges, if any. We can reduce from the full value of consideration. Then we can reduce cost of acquisition and cost of improvement. So we will see what is full value of consideration, what is cost of acquisition, what is cost of improvement in the subsequent slides. For time being, we need to compute capital gain or loss in the in this manner only. Indexation is not available while computing the capital gain. Indexation is available only at the time of computing tax payable only. While computing capital gain income under the capital gain, indexation benefit would not be available. So computation of capital gain, in that we can see full value of consideration. Section 72 covers the full value of consideration. Full value of consideration means full price without any deduction. That is, before transfer expenses or before getting any deduction, we need to take the sale price. For the following cases, full value of consideration shall be different. Say, for example, in case of insurance claim of capital asset, full value of consideration will be value of money received or the fair market value of the asset received. We need to take it as full value of consideration. I have mentioned the section as per Income Tax Act 2020-25 in the slide itself. Conversion of capital asset into stock in trade, because if a capital asset is converted as stock in trade, we can put it as value for the capital asset as say, for example, very nominal value. For protecting this, government has fixed the fair market value need to be taken as cost of full value of consideration, which means fair market value as on the date of conversion need to be taken as the full value of consideration. Transfer of capital asset by a partner to partnership firm as capital contribution, then full value of consideration shall be amount recorded in the books of accounts of the firm as value of the capital asset. These, in the capital asset definition, we will we specifically excluded some type of capital assets such as personal effects. If any personal effects has been contributed as capital asset to the firm, then this will not be covered as the capital gains will not be attracted. If we are transferring jewelry to the partnership firm, then such cases capital gains would be attracted. Distribution of capital asset by firm to its partner. First one is partner is contributing to the firm. Second one is capital asset shall be distributed to the partner by the firm. Then such case, full value of consideration shall be fair market value of such asset and the date of transfer we need to take it. Money or other assets received by the shareholders at the time of liquidation of company. Then in that case, total money plus market value of assets received on the date of assets on the date of distribution plus amount assessed as deemed dividend need to be taken as the full value of consideration, because deemed dividend is covered in the different sections, and deemed dividends always taxable in the income from other sources. We will take it in the later presentations. For time being, I'm just saying, for transfer of unlisted shares in a company less than fair market value, then such fair market value of such shares shall be taken as the full value of consideration. This is covered under section 79 of the Income Tax Act 2025. And for transfer of land and building, there's some special case, because transfer of land and building is a always special case for tax purpose as well as for full value of consideration as well as. For full value of consideration, we need to take the stamp duty value, not sale consideration. Only if sale consideration, only if the stamp duty value exceeds the 110% of the sale consideration. That is, if the sale consideration is 1 crore, then stamp duty value is 1 crore 20 lakh. Then in that case, we need to take the stamp duty value as the full value of consideration due to the 20% difference. If it is 10% difference, then we can take the stamp duty value. Then we can take the sale consideration as full value of consideration. So this will be beneficial, because if we are if the 20 lakh is saving means, then we need to pay reduced tax at the rate of 12.5%. If the as I said earlier, general rule is stamp duty value exceeds the sale consideration. This is before financial year 18-19. This is applicable for the financial year 18-19 and onwards. From financial year 2021 onwards, there's 10%. That difference will be given by the income tax, given in the Income Tax Act. So we have seen what is full value of consideration. You can see what is cost of acquisition. Section 72(1)(b) of Income Tax Act 2025 covers cost of acquisition. Corresponding section to the Income Tax Act 1961 is section 48(2). So what is cost of acquisition? Cost of acquisition means generally value at which asset we purchased. So that is cost of acquisition. Or we can take it as which includes the capital expenditure incurred to complete or acquire the asset. Say for example, we are incurring borrowing cost, which means interest on acquired cost, we can capitalize provided if conditions are satisfied. And in some cases, notional cost of acquisition will be taken as the cost of acquisition. What are the cases? First one is additional compensation received for compulsory acquisition. So if compensation is received, then it will be taxed in the income from capital gains. If additional compensation, we have approached to the court and we are receiving additional compensation, then such additional compensation need to be taken as full value of consideration. For cost, we need to reduce the cost, right? So for cost, we can take it as nil because we have already reduced the cost when original compensation is received. Second one is conversion of shares into debentures. We can take the if shares are converted as debentures, then we can take as the if the debentures are converted into shares, then we can take the cost of debentures. Conversion of preference shares into equity shares, then we can take the preference shares cost. Conversion of stock in trade into capital asset, as we covered in the earlier slide itself, we can take the fair market value as on the date of conversion shall be taken as the cost. For right shares, amount actually paid shall be taken as the cost. Actually paid means for right shares, definitely we are going to get the shares at the discounted price. So what price we are paying, we can take it as the cost. And for bonus shares, post 1/4/2001, it shall be taken as nil. In case of bonus shares received from the listed company, then we can take the fair market value as on the date of 31st January 2018 due to grandfathering provisions. We will see in the taxation aspects. So next one is depreciable assets, because depreciation is covered in the business or profession category. For transfer of depreciable asset, it will covered in the capital gains head, for which generally depreciation is charged block of asset concept only as per Income Tax Act 2025 as well as Income Tax Act 1961 also. So gain is always short term, which means any gain arising due to transfer of depreciable asset, it will be treated as short term capital gain only, irrespective of period of holding. We can hold any period of time, but it will not be treated as long term capital gain. It will be treated as short term capital gain only. Capital gain and depreciable asset, as I said earlier, computed on the block of asset concept only. Say for example, if we have a plant and machinery block, depreciation rate would be 15%. Generally, that plant and machinery block can be grouped and depreciated at the rate of 15%. So that 15% category needs to be entirely sold, then only capital gain is arised. Or if sale consideration is received more than WDV of the such block of asset, then such case only capital gain will be arised. I have given in the example in the next slide. We will see in the next slide. So block means group of asset with the same depreciation rate and within the same block of asset. And then is individual assets within the block are not treated as separately. So it will be grouped on the same block, and together with, we can take it as for depreciation computation purpose or transfer of block purpose, transfer of asset purpose also. If block is in the block, then gain or loss shall be sale consideration minus WDV of the block, WDV of the asset plus additions minus depreciation. Why depreciation is here? Because the block is not completely eliminated and some assets are remaining there and some WDV values there. For remaining WDV only, we are computing depreciation. In case of there is no remaining WDV, I have covered in the next slide. We will see. In case of no depreciation, then the result is maybe short-term capital gain or short-term capital loss. If the block is completely eliminated, then it will cover under capital gain or capital loss. So I have taken the example. First case is entire block is not eliminated, which means some of the assets remaining in the block. Say for example, I have taken the plant and machinery block. Opening WDV of the block is 20 lakh and additions during the year is 5 lakh. Sale consideration is 22 lakh. So total WDV before sale is 25 lakh. Sale consideration is 22 lakh. Since the entire block is not eliminated, remaining WDV is 3 lakh for the purpose of computing depreciation. So on the 3 lakh, we can compute the depreciation. Here, short-term capital gain or loss will not be attracted because entire sale consideration shall be reduced from the block of the asset. So this is the one typical case. Second one is block is completely eliminated. Say for example, I have taken the furniture block. The depreciated at the rate of 10%. So opening WDV is 8 lakh. Addition is nil, 0 for the year. So entire furniture is sold for the 5 lakh. So hence the entire furnitures are sold. There is no furnitures are remaining in the block. At the same time, there is no additions during the year. Then this case, short-term capital loss will be attracted. That is 3 lakh. 8 lakh opening WDV. We have sold the entire assets for 5 lakh. Then in that case, short-term capital loss will be attracted. So there is no depreciation because there is no WDV at the end of the year. Depreciation will be calculated if WDV exists. And, another important provision here, there is a major change: buyback of shares. So earlier we have covered depreciable asset. So we here I'm going to cover buyback of shares provisions. Section 2109 covers buyback of shares from the company by the company. Applicable when company purchases its own shares. Generally, buyback means if you are a shareholder, then company itself purchasing shares from you, then it is covered in the buyback. If you are transferring to another person or third person, it will not be treated as buyback. It will be treated as transfer only, and capital gains tax needs to be paid on such transfer. When company is going to purchase from shares from the shareholder, then only buyback of shares provisions will be attracted. From the tax year 26-27 onwards, so this is the major change in the capital gains provision. Capital gains only attracted if buyback of shares by the company, buyback of shares done by the company. Before that, there is some difference provision. I will take it in the next slide. The concept of deemed dividend and all no longer applicable as per the Income Tax Act for buyback of shares. There also the tax rates also so high because there are two tax. One is normal tax. Normal tax will be computed as per the other provisions of the Income Tax Act 2025. At the same time, additional income tax need to be paid on the buyback of shares in the hands of shareholder only. Because shareholder is transferring shares to the company need not to pay any tax. And for additional tax, in case of short-term capital gain, 2% for the domestic company. Case of any other person, 10% for promoter shareholders only. Other than promoter shareholders, additional tax not applicable. For LTCG, 9.5% for domestic company promoter shareholders, 17.5% for other shareholders, and surcharges is applicable at the rate of 12%. And anyway, health and education is at 4% is also applicable. So as I said earlier, this is the major change in the Income Tax Act 2025. So deemed dividend concept has been removed. If buyback is taken place on or after 1st October 2024, but before 1st April 2026, then the tax treatment is as follows. I have bifurcated into two tax treatment. First one is deemed dividend. Section 222F of Income Tax Act 1961 covers deemed dividend concept. Income Tax Act 2025 will not have deemed dividend concept for buyback of shares. So, deemed dividend, what is deemed dividend? Amount received by the shareholder on account of buyback of shares as treated as deemed dividend and taxable in the head of income from other sources. If we are paid some amount for purchase of shares, then such amount will not be allowed as deduction as per deemed dividend concept. This is as per Income Tax Act 1961. At the same time, we have paid some amount to purchase of shares, such shares, right? So that will be treated as capital loss. Whether short term or long term depends on the period of holding. That has been given in the red bolded area. Capital loss. Section 46 of Income Tax Act 1961 covers this treatment. So this transfer is covered under the deemed dividend, but Section 46A provides that value of consideration received by the shareholder shall be deemed to be nil, and cost of acquisition shall be, that is, at the time of acquiring the shares, we have paid some amount to purchase such share. So that will be treated as short-term capital gain or short-term capital loss or long-term capital loss. Here only loss will be arise. There is no gain because we are not going to take any consideration. That consideration need to be offered as deemed dividend under the head income from other sources. There are two heads, so we can't reduce the cost of acquisition. So then we will go to what are the tax rates for the capital gains. We will cover the exemptions in the subsequent webinars, because exemptions are very much broader and detailed understanding must be required due to claiming exemption in the capital gains head. We will take it in the separate session, because while in the webinar only I couldn't cover because I have 1 hour only. So what are the types of capital gain? We have, as I said earlier, there are two types of capital gains. One is long-term capital gain. Second one is short-term capital gain. So for long-term capital gain, tax rate is different. For short-term capital gain, tax rate is different. So I have given the comparative Income Tax Act sections also for reference purpose. At the same time, rates are, both the act rates are the same. First, long-term capital gain. If securities transaction tax is not applicable, then it will be covered in the section 197 of Income Tax Act 2025, and corresponding Income Tax Act 1961 is section 112. The tax rate is 12.5% only. And for long-term capital gain, if securities transaction tax is applicable and conditions are satisfied as per section 1, conditions as given in the section 198 are satisfied, then such case the tax rate would be 12.5% only, but in excess of 1.25 lakhs we can pay the tax at the rate of 12.5%. For short-term capital gains, if STT is not applicable, then normal tax slab rate only applicable. As per Income Tax Act 1961 also, there is no special rate, normal rate only that is taxable. For short-term capital gains, if securities transaction tax is applicable, the conditions has been same as per the section 198. That 4 condition needs to be satisfied. Then only it will be covered under section 186 of the Income Tax Act 2025. Then such case, STCG is taxable at the rate of 20%. So what is long-term capital gains tax? I have explained that section 197 of Income Tax Act 2025 covers long-term capital gains tax rate. So for long-term capital gains tax rate, the flat taxable at the rate of 12.5% plus surcharge if applicable, and health and education is at any way it is applicable. Deductions under section 123 to 154, that is ATC to ATU. ATC, we are, as per Income Tax Act 1961, we are claiming life insurance premium and tuition fees. Well, we are claiming it as reductions. So that ATC to ATU provisions as per Income Tax Act 1961, for as per Income Tax Act 2025, section 123 to 154 provisions, we are not going to take it as deduction for the purpose of computing capital gains tax. In terms of long-term capital, for short-term also, it will not be allowed as deduction. Long-term capital, as I said, long-term capital gains is taxable at the rate of without any basic exemption limit. Say, for example, if you are earning or 2 lakh, then such 2 lakh also taxable at the rate of 12.5%, provided if you are a non-resident. In case of you are a resident individual, then basic exemption limit of rupees 4 lakh will be available. And indexation benefit will be removed from the capital gains, and indexation benefit would not be available for any other asset other than land and building, or both. So I'm covering for indexation benefit option only, that is transfer of land or building or both. If the transfer is for claiming indexation benefit, there are some conditions, because what are the conditions? First, the transfer is a resident individual or resident HUF. They only claim the indexation benefit. Any other assessee cannot claim indexation benefit. Indexation benefit is available only at the time of computing tax rate, tax amount. At the time of computing capital, indexation will not be take place. So as I said earlier, as I shown in the previous slide, computation will be full value of consideration, less transfer expenses, less cost of acquisition, less cost of improvement. Indexed cost of acquisition, indexed cost of improvement shall be removed from the main section itself. So here it will be given for the purpose of computing tax amount. So whichever is beneficial, assessee can pay such tax only. So that too, assets acquired before July 23rd, 2024, then only indexation benefit available. If asset is acquired after 23rd July 2024, then such cases indexation shall not be available at the rate of 12.5%. If we are availing indexation benefit, then option 2 you need to go. That is, I am taking it as old regime. Old regime means not old regime as per Income Tax Act 1961. This is old regime as per capital gains. So we can pay the tax at the rate of 20% with indexation, or else we can pay the tax at the rate of 12.5% without indexation. Which means without indexation means we can pay the tax full value of consideration less cost of acquisition. In case of any transfer expenses, we can reduce from the full value of consideration. So then is section 198, because there are tax rate are both are same 12.5%, but here 1.25 lakh excess will be allowed as deduction, which means in excess of 1.25 lakh we can pay the tax. In excess of 1.25 lakh of gains, capital gains, we can pay the tax. First, for which assets this 1.25 lakh limit will be provided. There are 4 conditions. That 4 conditions need to be satisfied. Then such cases, this will be the 1.25 lakh benefit will be given to the assessee. First condition is the income must be chargeable under the head capital gains. Then only such 1.25 lakh benefit will be available. Then second condition is the profit transfer while transferring the long-term capital asset, being an equity share in a listed company, or equity-oriented mutual fund, or equity unit of a business trust, or unit-linked insurance plan. Then this case only 1,25,000 benefit will be available. Then condition 3 is at the time of transfer of equity shares, equity-oriented mutual fund, or unit of business trust, unit-linked insurance plan, securities transaction must be paid. If securities transaction tax is not paid, then we cannot take capital that 1,25,000 exemption category. So STT need to be paid for STT conditions. If a company is a listed company, then STT paid by the STT shall be attracted. The condition 4 is, in case of capital asset arising and transfer of equity shares acquired after 2004, STT paid at the time of acquisition of also. Which means condition 3 is STT need to be paid at the time of transfer for shares acquired on or after 1st October 2004. At the time of acquisition of shares also, STT need to be paid. So otherwise, this this provision, this 1,25,000 exemption will not be available to the assessee. And mode of computation of the cost of acquisition. So for mode of computation of the cost of acquisition, section 90 subsection 7 of Income Tax Act 2025 covers the mode of acquisition. So if it is covered, that means that 4 conditions are satisfied, then grandfathering provisions are applicable. So cost of acquisition, we can take the cost of acquisition as 31st January 2018 value, because in the February 2018, first time the listed equity shares got subject to tax as per the Finance Act, as per that Finance Act. So that time they have share markets are drastically down. So that transitional measure, the government has given the relaxation to the shareholders that they can take the 31st January 2018 shares price as the cost of acquisition, because this is the beneficial provision to the assessee. Because how to compute, we will see the how to compute the tax on the same. First, we need to find out the actual cost of acquisition of the share. Then we can take the fair market value of asset equity shares as on the date of 31st January, but it cannot be more than the sale consideration. That is, say for example, if we are purchasing the shares at ₹100 and we have purchased in the year of 2015, ultimately indexation benefit will not be available for this section. We have purchased the shares at ₹100, we have sold shares at ₹140, 31st January share market value is say for example 150. So in that case, whether that 150 can be taken as cost of acquisition? No, we cannot take 150 as cost of acquisition. This case, we can take 140 as the cost of acquisition. That I have explained in the step 2. Whichever is higher can be taken. So then we'll go to short-term capital gains tax. So STT, as I said earlier, for short-term capital gain, if it is not covered under section 186 of Income Tax Act 2025, then normal tax slab rate will be applicable. There is no special provisions for the same. And deductions, as I said earlier, for both I'll cover the STCG as per Income Tax Act 196 also. This 196 is like section 198. All 4 conditions needs to be satisfied for availing this section, which means 20% rate. Short-term capital gains, if it is covered under asset 198, then this 186 sections will be also applicable. In that case, we need to pay tax at the rate of 20% plus surcharge and health and education cess if applicable. Deductions will not be available for deductions means 80C to 80U as per Income Tax Act 1961, 123 to 154 as per Income Tax Act 2025 will not be available for short-term capital gains also. However, for basic exemption limit, it is same like long-term capital gains. So resident, individual and HUF can available the basic exemption limit of ₹4 lakh as per new tax regime that they can avail. And for basic exemption limit calculation, net taxable income minus short-term capital gain, where STT is applicable, we can reduce the same. After deducting the amount, the balance short-term capital gains is taxable at the rate of 20% for conditions for the assets covered under section 196 of Income Tax Act 2025. So we have broadly covered capital gains and capital gains tax, and we will go to set off and carry forward of capital losses. We will take the exemptions in the next presentations or next webinars. For short-term capital loss, we can set off against the short-term capital gain as well as long-term capital gain. For long-term capital loss, we cannot set off with short-term capital loss, short-term capital gain. We can set off only against the long-term capital gain. The loss shall be carried forward to 8 years for long-term capital loss as well as short-term capital loss. In case of this long-term capital loss and short-term capital loss shall not be set off against any other head. So only capital gain, there is only capital gain head, we can set it off. In case of we are late filing the income tax return, then such carry forward of loss provision will not be applicable. So we can we need to lose the carry forward of loss provisions. So please ensure that file the returns before the due date. For the assessment year 26-27, that is financial year 25-26, the due date is for ITR 1 and 2, which means the person's assessees who does not have any business income, the due date is 31st July 2026. For assessees who is having business income, the due date is 31st August 2028. For assessees who are subjected to tax audit, the due date is 31st October. For the tax audit due date, 30th September. So please plan that. Timely file help to set up the losses. In case of if you have any losses, we can set up the loss with the subsequent years, because set up carry forward of loss shall be taken for the next 8 years. So thank you all for attending the webinar. In case of you have any queries, please let me know, and please put it in the chat box. I'll let us address. Ravi sir has asked the capital gains for NRI. So we will cover specifically for NRI in the next webinar, because next webinar I'm going to take exemptions and taxability for NRIs. So we will cover it in the next webinar, sir. We will let you know, sir. Manoj Kumar sir has asked, the transfer of asset from one company to another company will attract capital gains tax. Yes, sir. It is a capital. In case of any capital asset has been transferred to another company, not a 100% subsidiary company, then capital gain would be attracted. Provided if you are transferring it as lump sale, then capital gain will be attracted as per different provisions. Lump sale, we will cover it in the next webinar, sir. Sure. So for presentation, please message to that number. I will share the presentation, sir. Sure. Thank you all for the attending the webinar. Once again, thank you. If you have any queries in the capital gains or return filing, you can definitely text me or call me. I have given the number in the Q&A slide. Thank you all.